All right, in this lecture, son of a bitch. All right, in this lecture, I am going to talk about the solvency ratios. There are four generally accepted ratios that I'm going to go through. The first one is the debt ratio, and the debt ratio is total liabilities divided by total liabilities and equity, or total liabilities divided by assets, either one, right? So in this particular example, we have a debt ratio of 73%, meaning our total liabilities are 73% of our total assets, or our total liabilities and equity. Okay, the debt ratio shows liabilities as a percentage of total assets, obviously. The equity ratio shows the percentage of equity as a percentage of assets, obviously. Debt to equity ratios, right? So we're going to divide total liabilities by total equity. This ratio measures what portion of a company's assets are contributed by creditors. A large debt to equity ratio implies less opportunity to expand through the use of debt financing. I feel like that makes pretty good sense. And again, what you'll learn in some of your finance classes is that we do want debt, right? So in our personal lives, we always view debt as being kind of a negative, but in business, debt is actually a positive. It's a low cost of capital, and it provides some tax incentives. So if you use debt to finance some of your business, you actually are increasing the value of your company. So we don't want to get too concerned with, high debt to equity ratios. However, there is a point of diminishing returns where if it's too high, then you're running the risk of potentially going into bankruptcy, right? If there's a downturn in your market and you're not able to meet your obligations, that's actually kind of a red flag. So you do want it high, but you don't want it too high. And where it should be sort of depends on the industry, on the company, the state of the economy. It's rather complicated to identify the exact point. For now, we're just getting comfortable with at least doing that or being familiar with the calculations. Okay, last solvency ratio times interest earned. And this is essentially comparing our income before income taxes and interest relative to our interest expense, right? So what's the spread between how much money we're making and how much our interest expense is? Typically, the higher the spread, the more likely it's the case that we're going to be able to continue to pay our interest moving forward. This particular company's got 19.4, meaning this is all of its income before interest expense and income taxes, and this is the interest expense. So we're substantially higher. And if you're lending a company money, you would feel pretty good at the moment that the interest expense is substantially lower than the amount of income that the company's making.